So good morning and welcome to CSIS. I'm Frank Verrastro. I'm a senior vice president here, and I have the honor of holding the Schlesinger chair in energy and geopolitics. A couple of administrative items. In the event of an evacuation, which we don't expect, but we've had before, since you came in the front way, we're on the second floor here. It's really down the steps, out the front, assemble across the street from the hotel. You can also take a left going out the doors, come out the back through the alleyway, and that brings you down by National Geographic on M Street. So we're good. This morning's session, I'm really kind of excited about. In August or September of 2014, so colleagues here at CSIS, so me, Guy, Kevin, Larry Goldstein, wrote a couple of items when people were still talking about the V, that we were going to come out of this turnaround really quickly. And we thought it was going to be lower for a lot longer. When you looked at the supply that was coming out in the world and the opportunity pool, and then you looked at what we thought was kind of bleak demand, we were starting to build up overhang in the inventory system and just didn't see how you could work this off that quickly. Over that time, production has continued to increase. Stocks have continued to be built, and the economic situation on the demand side has gotten a little bit weaker and caused us all concern. About a year ago, we assembled a panel similar to this, and it was such a huge success. In fact, almost everyone on the panel nailed this right, much to the chagrin of some of the investors and also the pain that's going on in the industry. And I've been through a couple of these from the private sector side, and it's not fun, believe me. So we certainly understand that. But how long will it take to move out of this? The session and the timing of it, we totally timed this with Doha and Tehran. Only kidding. But we saw that the market moved up today and just don't see how you can get that kind of an agreement. A freeze where you're already producing more than the world demands means stocks continue to build. And the Iraqis have already said, well, you know, the northern area in Kurdistan, that doesn't count. We haven't seen the Iranians' number yet. And the Saudis are pegged at 10.1 or 10.2. Brilliant tactical move. We've changed the narrative here from getting rid of oversupply to let's freeze in an oversupplied situation. And yet the market's moved up a couple of dollars over the weekend. So we'll see how that goes. The session that we have today, though, I would describe this as kind of the dream team of oil market analysts, and we're just very excited to have them. Collectively, and I'm being kind here, they have over 100 years of experience in oil markets, refining, and economics. But they're also personal friends, and one of the real benefits of this job is when you're able to do good substance, and you will get a content-rich presentation or set of presentations today, but also do it with people you enjoy, and you're able to engage in that kind of conversation. We're changing the schedule a little bit. Howard Gruenspecht will still start things off. Howard is, I think, the longest-serving deputy administrator at EIA, and over the past 35 years, he's built up an extensive resume doing economic, modeling, energy, and environmental work. And we usually get Adam, but we are especially pleased to know that they let Howard out and we can have Howard with us today. Rusty Braziel is the president and CEO of RBN Energy. You've seen Rusty here before. It's a leading energy market analysis and advisory firm. Before he created RBN, Rusty was an executive at Chevron Texaco. He was the co-owner of Bentech, and he's just published a new book. Should have had a copy of it. I'm sure he will provide a copy of it. And it's a bestseller. It's called The Domino Effect, and I would urge you all to read it. It's a great primer on markets and seeing how the markets operate. David Knapp is another longtime friend. He's chief energy economist and senior editor of global market analysis at Energy Intelligence. He's also an old FEA, DOE alumni, and he was with the IEA before that. He did market analysis. And then John Ayers. John is my go-to guy on refining, and I spend a lot of time in the refining business, but this guy knows it perfectly. He's executive vice president of Turner Mason and a refining downstream expert, and he started his career with Exxon. So we think that we've got a bunch of slides that we'll be able to present to you, since C-SPAN is covering all of this with the permission of our presenters. We will put them in PDF format and we'll make them available. But we'll be able to get this started. I just thought I would do just a little bit of framing just to get us going. So the bulls and the bears. 2014, 2015, there was this fight about we in a bull market, we in a bear market. And we've talked about this ad nauseum here at CSIS, and we think the bears win, and there's a lot to be said for what's going on, but we're looking to continue this. When you look at GDP growth in OECD, non-OECD countries, it's hard to see how demand overtakes supply anytime soon. When you look at the actual market, you'll hear a lot from Rusty and David and Howard today on the supply side. So notwithstanding what's going on in the discussions, OPEC production is still high. The U.S. is resilient, and we'll talk about the economics of the rollover and what that investment means. We spent some time last year talking about stupid money, where every company thought that investment in their competitors that didn't have as robust a balance sheet or as good enough properties was going to be a problem down the road, and that's coming to fruition. Probably sometime in April, we will do financial markets and energy, which we think will be a really good discussion. On the demand side, since these guys will do a lot on supply, on demand side, you need to look out for both the non-OECD countries where the big growth was going to occur that seems to be slowing down, and then what that means for banks and lenders. And that's kind of the key going forward. And even though in the globe there's a lot of risk, whether it's Syria, Iran, Iraq, Venezuela, Nigeria, we've become complacent to that. And so we think we're living in a different world. This is the chart of doom. This is supposed to elicit a lot of laughter. The problem here is when you look at the OECD countries, you look at the EU, you look at Russia, you look at Japan, the United States and China seem to be the only ones that are doing well. But when you look at the estimates and trend lines for where China economic growth and U.S. growth, when we started, we were in the 3s. We're now down to about 2.2. China started in the mid-7s. There are some people that think that China isn't at 6.2, they're really at 5.9. What does that mean for the global economy and economic downturn? And so then when you start looking at the rollover, why the rollover on the supply side has been so resilient, it's not only the properties and the geology, but it's the investment and the fact that we've reduced the cost structure. We've got a lot of great plays in the United States, the Permian, but at $30, people aren't making money. And so this is not sustainable. And the long-term event, as we've seen time and time again, means that prices will rise. And what does that mean to the economy, and what does that mean for a price spike for the industry coming back? This is one of EIA's slides, and Howard will talk about it, but I think everyone will touch on it. It's when does supply and demand come back into balance? When do we start dipping into that inventory and start withdrawing the overhang so that we can bring the market back in balance? And we're literally in a situation where as we get to the third quarter, you can still be either adding to that inventory or starting to withdraw. But withdrawing won't be fast enough to get you out of this anytime soon. And then refining. So one of the reasons we brought John on the panel is, with the exception of extended crude burn in Saudi Arabia, most crudes go to refiners to be processed. That's their marketplace. But the characteristics of a refining, when you start looking at the different crudes around the world, light sweet is not the same as heavy sour. We've got a lot of production that's coming from the Gulf of Mexico. We have refineries that are configured to make certain product slates, and the economics to optimize those refineries is based on both the inputs, what your fuel costs are, and the outputs, what your high-margin products are. And so we're looking to John to give us more detail on that as well. So please, if you'll join me, I'd like to start this panel, and I'm going to welcome Howard to the stage, and we'll kick it right off. But thanks for coming.
Forward and back, or up and down?
Just down.
Down. Just down. Sounds like something for oil markets. So I'd like to thank Frank, Verrastro, Sarah Ladislaw, and the entire team at CSIS for organizing the session and inviting me to participate. The truth is, Adam would be here if he was not in Saudi Arabia. It's not that. And you would learn more. But I'm very much interested in hearing the insights of my fellow panelists and also to the constructive interaction with everybody in the room at the end of the session. So in this town, it's often said regarding discussions of energy issues, and I see Senator Johnston here, that where you stand is where you sit. The Energy Information Administration is a statistical and analytical agency within the Department of Energy, provides independent and impartial data and analysis. We don't take positions on policy issues. and by law, our information is issued without prior review or approval by the department or other federal agencies, so my comments do not necessarily reflect their views. Now I can say anything I want. So, very important. So, in 1850, this really starts a long time ago, almost a decade before Colonel Drake produced oil from his first well in Titusville, Pennsylvania, Charles Dickens already had a keen insight that seems directly applicable to oil markets. Mr. Micawber, a character in David Copperfield, described the thin line between happiness and misery as follows: annual income, 20 pounds, annual expenditures, 19 pounds, 19 shillings and 6 pence, result happiness. Annual income, 20 pounds, annual expenditure, 20 pounds, aught and 6, result misery. So Dickens clearly recognized that the balance between happiness and misery can be dependent on a fairly thin margin. Micawber's income and expenditures are apparently both totally inelastic, so his bliss outcome depends critically on whether his expenditures lie to the right or to the left of his supply of income. So we're here to discuss the state of current oil markets rather than literary classics. And oil supply is not completely inelastic, but it certainly has yet to have been significantly reduced in response to the sharp slide in prices that began in mid-2014. Demand, which I will talk about a little bit also, is also fairly inelastic in the short run. So, unlike Micawber, who looks at the bliss market only from his own perspective, an oil producer's misery, and there really is much misery in U.S. Producing regions, as well as among major exporters around the globe, can be an oil consumer's bliss. Although, again, it's not clear that it's that blissful. It's fun when you go to the gas station, but the economy's not doing that great with it. But I do see some happy faces when I stop near the foot of the Key Bridge to fill up my car, where for the first time in many years, the dollar digit in the price is a 1 rather than a 2, a 3, or even a 4. Even the national average pump price of diesel fuel has fallen below $2 per gallon in EIA's latest weekly survey. And diesel for many years now has been more expensive than gasoline. Gasoline has dropped below $2 some time ago. A little bit more about prices later. So, well, here it is. You've already seen this, because Frank stole it from me, but that's fine. So unlike Micawber, who evaluates the situation at one point in time, the balance between production and demand for oil plays out repeatedly. Since early 2014, EIA's accounting suggests that global production has consistently exceeded demand, as reflected by the difference between the blue and the brown lines, the blue being supply, as shown by the green bars measured against the right axis. Global stocks of crude oil and product have been steadily building. EIA forecasts continued global stock builds through the first half of 2017, but at lower quarterly rates than experienced throughout 2015. So in the first half of 2015, supply exceeded demand by about 2 million barrels a day. That dropped to about 1.6 or 1.7 million barrels a day in the second half, but that's still a pretty big contribution to global inventory bills. So for many on both sides of the oil market, prices are often viewed as the most important summary statistic. So oil price forecasting is, of course, a fool's errand. Unfortunately for the EIA staff and me, it's one of our assigned duties. So this is, for better or worse, the baseline forecast for both Brent and WTI. We have at about $38 a barrel in 2016 and $50 a barrel in 2017. However, our forecast, and those of others, should be taken with more than a few grains of salt, as perhaps best demonstrated by the value of options and futures contracts for delivery for oil over the next 1 to 2 years, which imply that a very wide range, ranging from the dotted lines on that figure, ranging from about $20 per barrel to over $100 per barrel by the end of 2017, is required to capture a 95% confidence band for the market's expectation of prices. This is not a statistical calculation. This is based on the value, again, of options and futures. And the market's confidence band, again, shown by those dotted lines. So why are players with skin in the game so uncertain about the future price path, even over a 3 to 21-month period shown here? Some reasons why prices might be higher or lower than conventional wisdom, whatever that is. Oil demand growth on the higher price end, oil demand growth surprises to the upside. That could be either economically driven by economic growth. I think Frank mentioned that. Prospects look pretty dim there, but, could surprise to the upside. Key OPEC producers actually do something with respect to output. There are some significant disruptions in production that are not built into the kind of outlook we have for supply. Social unrest in oil-dependent countries leads to supply disruptions. Non-OPEC production slows more than expected. So there are lots of reasons why prices could be higher. There are reasons why prices could be lower. Some demand-driven, some supply-driven. World economic growth is lower than projected. I think Frank touched on the projections are pretty anemic, but it could be worse. Despite the discussions in Doha of freezing productions at very high rates, productions could rise. There could be a reduction in unplanned outages. EIA regularly tracks unplanned outages throughout the world, and there's a pretty big set of them that are there and still built into our outlook. Maybe Iran could do better than we expect they do with sanctions being lifted. So again, there are clearly, this is just supposing what's driving those dotted lines, but the market is providing those dotted lines. So now I'd like to move away from prices and look a little bit at the underlying supply and demand situation, beginning with supply. I'll start with the outlook for U.S. supply, which has attracted lots of interest both at home and globally. I think perhaps maybe too much, if it's possible, maybe too much attention is being paid to domestic developments, but they are important. And we do a lot of work in the area, so that combination is going to lead me to talk about it. So this is our latest forecast for U.S. supply relative to the fourth quarter of 2014, and it presents an interesting picture. So average 2015 production shown by put all the components together, shown by the blue line, was about 150,000 barrels a day above the level in the last quarter of 2014. However, if you look at the blue line, you can see that EIA's forecast expects U.S. production to be roughly 800,000 barrels per day lower than the fourth quarter 2014 level by the third quarter of this year and remain close to that through 2017. Looking at the components of production, which is pretty important, we see very different trends for different parts of U.S. production. So lower 48 production, that's the yellow line, which notably includes the tight oil that everybody talks about, has been the source of certainly production growth from 2011 through the beginning of 2015, is where nearly all the adjustment is occurring. And we see quite a big, in early 2015, we were about 200,000 barrels a day above the fourth quarter of 2014, and we see that lower 48 production dropping by more than 1 million barrels a day relative to the fourth quarter of 2014 level. So a very big drop there. Alaska production, the brown line, continues on a shallow declining trend, almost imperceptible with some seasonal effects there for when they do their maintenance. And then the green line is Gulf of Mexico production, continues to rise as production projects whose major investments were made long before the recent price declines come online. Several of them came online in 2015. More of them come online in 2016 and 2017. So the blue line is sort of the sum, if you will, of those three other lines. So again, we see U.S. production pretty weak, at least over the next 2 years, relative to where it was at the end of 2014. So not going to give a quiz on this one. I don't see why it got to be slide 13, because it isn't slide 13. But, so again, beginning in October 2013, EIA has provided a monthly drilling productivity report that focuses on 7 key shale production regions for oil and natural gas. Here I'm only, mercifully, I've only put up slides about 4 of them, which are where the oil is. And this is from this current drilling productivity report. And again, it's really a gestalt thing, but just let me offer a few summary observations. So starting with the first row, it's no surprise that rig counts, to the black line, and this goes all the way back to the start of shale world. These graphs run from, I think, 2007, even though I can't even read it on the screen. But yeah, 2007 all the way through now, all the way through March of 2016. But you can see that from 2014, rig counts have declined dramatically. That's about black lines in the top row. However, new well productivity per rig, shown by the brown line, has continued to rise, which has cushioned the effect of lower rig counts on new well production. Turning to the second row, legacy well oil production declines have generally been increasing over time, as shown by the brown lines, which again, the top line on the brown is 0. And at the beginning, there's not much of a legacy well production decline because there aren't very many legacy wells. But over time, as we've accumulated more of these legacy wells, the legacy well production decline has risen. However, if you have very sharp eyes, you'll notice that in 3 of the 4 regions, the decline in production from legacy wells has actually started to decrease in recent months, as shown by the upturn at the end of the lines. This reflects the decline in the decline rates of, second derivative here, the decline in the decline rates of legacy wells as they age. And that's particularly true as the legacy group includes fewer and fewer new wells with steep declines at the start of their production profiles. Remember, because fewer new wells are being drilled. So it is if you view the notion of sort of like your production, you're riding a bicycle into the headwinds of legacy declines. What's kind of interesting is that the headwinds are sort of slackening a little bit over time. So the bottom row shows the summary outcome taking account of both new well and legacy production in all areas, but the Permian is declining, and the Permian itself is now turning. We have Permian at about a 0 change in March 2016, excuse me. So again, this is like another sort of more legible picture of the same thing. Hopefully the bolder lines in the middle are the same lines as shown in the charts for those relevant areas on the bottom chart. But we did a thought experiment which compares those bold lines, which we consider to be the actual, well, historically it is the actual production trajectory with a little bit of a projection for February and March of this year. And we compared it to one alternative that holds the rig count in each region at its October 2014 level, and those are the dotted lines, and not surprisingly, they're higher than the bold line. And another alternative where no new wells were drilled after October of 2014. And in the Permian Basin, where the vertical rigs that are less productive than the horizontal ones have really borne the brunt of laying down rigs, that the dotted line is not too much higher than the bold line. So really, those vertical rigs weren't getting us that much. And again, the horizontal rigs production use has sort of held up, starting to fall off. It's a very different picture in the other two plays. The Eagle Ford shows the largest gap between the top and bottom lines. The difference between production with October 2014 rig counts sustained by the time you get out to March 2016 is roughly 800,000 barrels a day higher than what we believe to be the actual production. And I think the Bakken falls somewhere in between, with the bowl line about in the middle of the continued drilling at the rate of October 2014 and no drilling at all past the fourth quarter of 2014. So enough, because as I said earlier, I think when we think about the state of the oil markets, it's very natural for us here to pay great attention to what has happened and what might happen with domestic tight oil, but a very strong case can be made that those interested in the state of oil markets would do best to turn their attention elsewhere. So this is these pies, and I violated EIA rules by using pie graphics, but I didn't know how else to do it. Puts the components of U.S. Adam's out of the country, so I can violate the rules. Graphic puts the components of U.S. oil production in the context of overall crude oil supply in EIA's short-term energy outlook for this year and next. The pies are actually pretty similar to each other. So really, when we talk about tight oil or shale, we're talking about the blue areas, which we have at about 4.74 million barrels a day in 2016 and 4.46. Wouldn't trust the last digit, maybe not even the second to last digit. But, you know, that's what we're looking at. But arguably, the state of the oil markets, both within the EIA forecast period and beyond, will depend on crude supply developments in the rest of the world. And that's the red area of these pies. And again, this is just crude oil. That's why it doesn't add up to something like 90-something, 93, 94 million barrels a day, because that would include all the natural gas liquids, and it would include refinery gain. And I'm just looking at crude oil. So in looking at the red areas, I think, rest of the world, three distinct issues merit attention. One is geopolitical events, and we don't model them. You know, we don't have a model of the stability of Venezuela or of, other things that might happen. We don't project anything about that. But clearly there's opportunity for geopolitical events in all kinds of places. Oil market conditions are putting extreme pressure on countries that rely on oil exports to fund their governments and support programs that may be important for social stability. Clearly, a change that disrupted a significant portion of the red supply could have a very significant and immediate effect on the state of the oil markets. The second is exporter decisions. So Frank, I think, touched on his view of some of the recent things that we've been seeing. Whether it's real, whether it's not real, whether it means anything. But many analysts certainly accord a large role in the current oil market situation to exporter decisions, including the decision by Saudi Arabia in late 2014 to maintain its production at high levels rather than reduce production to help restore the balance between supply and demand in oil markets, a role that it's often played in the past. A future decision by major exporters to again change their strategy cannot be ruled out. Now, Frank, I would happen to agree with Frank that what's happened so far does not constitute such a decision, but such a change, if it were to occur, could significantly affect the markets. And the third big thing affecting the red, in my view, is investment. And unlike geopolitical events and exporter decisions, which are often quite idiosyncratic and extremely difficult to foresee or model, I think, investment has really changed in this sector. I mean, there's been tremendous cuts in the amount of investment being made. Now, if the red was like shale, you'd see the effects of those cuts pretty quickly, because shale has a very short period sort of from investment to production. For the more conventional or traditional oil investments in major projects, it's a much longer period. And at least in this forecast, we're not seeing significant fall off in the red production through 2017. But at some point, this drop off in investment does have an effect. You know, there was a lot of work done by the IEA and others about natural decline rates, in conventional oil. They're pretty significant. Investment has not stopped completely, but it's been cut very substantially. And at some point, one would expect that to show up in the, it is showing up in the blue because, again, the nature of the investment cycle for shale. But at some point, it will start to show up in the red. And a few percentage points in the red is a lot of oil. And that helps to bring, whether it's viewed as a good thing or a bad thing is another question. But that effect can have a very significant effect on the balance in world markets. So, I'm not a Washington Capitals fan. I'm a diehard Pittsburgh Penguins fan. So I don't advocate rocking the red or other such foolishness. But as oil market analysts, we should be watching the red very carefully. So, the other thing I should note, I want to sort of turn to demand, and then I think I'll stop. I don't want to monopolize time. But another, way at the beginning, we said there was sort of two things that you had to look at, supply and demand. Spent a lot of time talking about supply. Frank rightly said that we should also consider demand. And so here's our view of demand. We do see some, 2016 and 2017, we see continuing demand growth, about 1.25 million barrels a day in 2016, 1.45 million barrels a day in 2017. And combined with our outlook for relatively stagnant global supply, encompassing both the US and the rest of the world, that underlies our projection for more balanced markets by the second half of 2017. That's way back on the first slide. You've probably forgotten about that. But demand really matters. And of course, EIA's view is not the only perspective on demand growth. Our view happens to be similar to that of the International Energy Agency, which I think in its most recent oil market outlook has lowered what was a much higher outlook for demand growth to something much closer to what we have. It just so happens, again, we're not trying to do this. It happens that OPEC has a similar view in their latest documents. But again, some of private banks and others, I won't quote them by name, have significantly different views. And again, looking back historically at last year, there was a wide range of views. When we started 2015, I think EIA was at 1 million barrels a day growth in 2015. Of course, we didn't have prices where they were. It ended up being somewhat higher. But there was a significant range among reputable people on the demand side. And so it's real important to say that we don't know. But it's very important. And over 2016 and 2017, in this picture at least, you get 2.5 million barrels demand growth. And that does help you with your sort of balance situation. And then I think the last, one I want to look at, economists like to draw supply and demand curves and diagrams with quantities on one axis and prices on the other. This is not that. But it's very important to keep in mind that demand, at least, is not just a function of price, it's also a function of economic growth, which itself has a powerful independent influence from prices, particularly in developing countries. So this is a little bit of a tale of woe. EIA is very transparent, and what this shows you is across, so starting in January 2012, we started, the first blue line, we started in our short-term outlook looking at 2013 oil markets. And at the beginning of 2012, we had growth outside in the non-OECD countries at about 6%. But over the course of the period that we kept on looking at 2013, you'll notice that 6, almost 6, fell to under 4. Really, toward the end of 2013, we kind of had most of 2013 in the can, so we knew what the number actually was. So we had started out looking at 2013 with a higher outlook for the economy in the rest of the world than actually came to pass. And if you look at the same thing when we started with 2014 on the brown line, or 2015 on the green line, or 2016 on the black line, and then this little stub of 2017 at the far end, all those curves have a downward slope. So we have been starting out our views of what demand might be in recent years with economic growth that has been too high. So with that, that's another thing we got to keep an eye on, especially in view of what Frank and others have had to say. So there's one more slide, but I don't think I'll do it. And I should do it? I shouldn't do it. You tell me about time. I'm worried about time.
You can do one more slide.
Okay, I'm paranoid about I want to hear about my colleagues. So this is one that I've been doing a variant of this thing I think I used it here at CSIS. This is a really much longer term view. So in addition to watching the effect of investment, on what's happening in the rest of the world, another thing I would watch, sort of, can exporters cohere? And this kind of looks at the lessons of history, because I'm an old person. And there are two 12-year actual periods, and then there's something out of our Annual Energy Outlook 2015. And the important thing to note is that, like in the first 12-year period, 73 to 85, which ended with, I guess, describes Saudi Arabia, which had been cutting oil production. In 85, their production got to be very, very low. And in the immortal words of Roberto Duran, said no mas. And in the beginning of 1986, they kind of changed their policy. But here's what happened to the world, on the demand side. World liquids demand in that period increased by 3 million barrels a day. OECD went down, non-OECD went up. There was a tremendous increase in non-OPEC supply. OPEC supply went down. Part of it was sort of Saudis cutting production, but part of it was also Iran, Iraq, doing all the things that, they've done so well for so many years. Changing a little bit now. And it ended with a big kind of price decline. And then the next historical period is 2000 to 2012. And again, OECD consumption went down by 2 million barrels a day, but non-OECD demand went up by 15 million barrels a day over that period. A much different thing on the production side. So we kind of needed 12 million barrels more, and 6 of it came from non-OPEC and 6 of it came from OPEC. And we had pretty high prices. In 2012, we had sort of historically high sustained prices. Maybe not the peak level that was reached in July of 2008, but it was a very high price. So 2 historical periods, very different outcomes. One ending in low oil prices, one ending in high oil prices. So I thought it would be interesting to look at, well, what does this say about, what might happen in 2013 to 2025? And so we had this outlook for demand. Again, I don't know, maybe too strong. So one thing I noticed is that in our outlook, at least, we had a +1 on OECD demand, and the last 2 periods it was negative. But okay, it is what it is. So we have an overall demand of increase of +12 to +13, and then in this picture, and really the only difference is we had the non-OPEC supply growing by 10 to 15. Really, all we did there was 10 to 15 million barrels a day. All we did there was carry 2 different versions of the U.S. picture to get that spread to 2 different views, and then kind of looked at the implied implication for, I guess, what's often called the call on OPEC. And, do the math, we ended up with a -3 to +2, which, interestingly, is somewhat between those 2 prior historical periods. The other thing that's going on, of course, is that OPEC itself is quite different. So you have a situation where, Iraq is clearly getting back in the game, which it hasn't, been in for some period of time under the previous regime. You have Iran also getting back in the game. So, you can't just read off the numbers like, well, it's closer to the +6 than to the -14, because within the exporting group of countries, you have more people who want to produce. And there's a real interesting question, I guess, of what will happen there. And this is something this is a personal hobby horse of mine that I've been kind of watching, and I don't know how it's going to come out, but I think it's a useful way of thinking about maybe this sort of longer-term issue. But if Iran and Iraq both really want to significantly increase their production, the implied, implication for the rest of OPEC, if they were going to fit in this kind of system is, very, very challenging. So with that, I really am done, and I thank you very much.
Oh, sorry about that. After the message that David and I had last year when we were here, I was kind of surprised that Frank had us back. Unfortunately, I'm afraid that the story that I'm going to be telling this year is worse than last year. So anyway, I'm going to start this. That was funny, Frank. So I've used this tired old metaphor 2.0 as the title of the presentation, certainly not because it was very original, but I think it really captures what we're seeing today in the markets for gas and crude oil and NGLs. And I'll start with the slide that, it's a version of a slide that I actually used last year, and it shows the price cycles that we've seen really since the inception of the shale revolution. As a matter of fact, even going back before that. And the pre-shale era, 2007, 2009, back in those days, crude oil and natural gas liquids moved in lockstep. When one went up, with the commodity price run up in 2008, they all ran up, and then with the meltdown, they all ran down. And, that was the way that a lot of folks thought it was going to work. But of course, by that point in time, shale had really come into its own. Shale production had increased. When crude oil and natural gas liquids increased after the meltdown, gas prices didn't go along with them. Gas prices held down there. And so what did producers do? Well, they started to shift their budgets over to drill for lots of natural gas liquids, some crude oil, but the crude oil didn't come all that quickly. So what happened next? Well, gas stayed down, still in oversupply. But we started to produce too many natural gas liquids, propane, butane, ethane, and those prices came down too, just exactly like prices had in natural gas a few years before. Well, then what do producers do? They start shifting even more of their drilling budgets to drill for crude oil, and then that got us to that final phase there of crude oil prices coming down along with everything else. So what does that mean? Well, that's when I divide the world up into 1.0 and 2.0. 1.0 is that time period between 2009, after shale really started having an impact on the marketplace, and basically Thanksgiving of 2014 when crude oil prices crashed. And what made that shale 1.0 is that every time a commodity crashed, every time something went down, the producer just did the next logical thing. They moved to the next commodity. Well, guess what? We're out of commodities. Now, producers are dealing with what I'm calling Shale 2.0, and Shale 2.0 just simply says, I cannot solve my problem as a producer anymore by moving to the next commodity. My only choice is to deal with this situation however I have to deal with it, with lower cost, smarter drilling, or cutting my capital budget, or whatever it may be. There's one other aspect of Shale 1.0, though, that is going to be with us for quite some time, and I'll call that the aftermath. So we're going to look at this slide, and it's going to be the exact same crude oil slide that we looked at on the previous slide. It's got all the clutter taken out of it, so you can see a little bit more detail of what's happened since 2009 to now. And now I'll give you a visual metaphor that you might be able to envision what that might look like as we look back on it a few years from now. I wonder if we'll look back on that a few years from now, and think of this period that we've just been through as a bubble that drew in billions of dollars for producers and for midstream companies that now has to be worked off, just exactly the way we had to work off the inventory of houses in the housing crisis, and exactly the way we had to work off the inventory of dot-com companies when the dot-com bubble burst. I'm not saying that's going to happen. I'm just saying that's an interesting thing to think about. So let's come to terms with exactly what's happened over the last few years. This is crude oil production, peaking at about 9.7 million barrels a day. And Howard, these are all your numbers, so hopefully you recognize the majority of them anyway.
They must be right.
They must be right. And declining to 9.2 million barrels a day now. Not much of a decline given the 70% cut in prices since April 2014. This is lower 48 dry gas production. And what we've done is we extended these volumes out beyond EIA's numbers to look at what's happening based on flow data into pipelines. And basically what that says is we were down a little bit in production at the first part of this year, but right now, over the past 2 weeks, we've hit all-time record levels natural gas production in the United States. So it is just blowing and going right now, even with prices right now well below $2. And natural gas liquids, LPG, this is propane and butane, the fastest growing energy commodities on the planet, nothing slowing down there at all, again, based on the best EIA statistics that we can come up with. So what does that mean in terms of the relationship between the production volumes and what's going on out there in the market? Well, there's actually part of the market that's behaving the way you would think it would be, and that is the relationship of oil price and rig count. Pretty close correlation between those two. Oil prices go up, rig count goes up, oil prices come down, rig count comes down. Just exactly the way the economist would tell you. Same thing on the gas side. Pretty close correlation between those two prices. So, just a second. We just got through looking at production of those two different commodities increasing at the same time. We're seeing huge crashes in the rig count. So what's going on? And of course, the answer there is productivity. This is a version of a productivity slide that I showed last time I was here, updated for a year, and it's worth looking at the update. This is EOG's Eagle Ford performance from 2011 to 2015. It took them 22 days to drill a well in 2011. Now it takes a little less than 8 days. All we do is take those numbers and divide them into 365 to say how many wells can a given rig drill, and it was 16 in 2011. Now it's up to 47. And those wells are a lot more productive. They're drilling less wells, but the wells that they are drilling are considerably more productive, 88% more productive, 533 barrels up to 1,000 barrels a day. So a lot more, the IP rate is a lot higher on those wells. So all we're going to do is just do the math of doing 16 wells times 533 and then do 47 wells times 1,000 to see how much production a given rig can produce over and above what it could produce 5 years ago. And the answer is 407% productivity improvement, 9,000 barrels a day from a single rig, up to 47,000 barrels a day from a single rig. That is where all that production is coming from. And of course, we love the EIA drilling productivity report because it shows the same thing, and we don't have to do the math. They've done all the math for us. So a 276% improvement on the Eagle Ford, a 231% improvement on the Bakken, a 578% improvement on the Niobrara. Those are all oil plays, and then a 500% improvement on the Marcellus and Utica. What does that tell you? That tells you that a single rig can do 5 times the work that a rig could do 5 years ago. So the fact that we don't have very many rigs drilling is not that big a deal when you look at how productive these rigs are now, at least from the standpoint of the markets. Of course, if you're in the business of drilling with those rigs, it may be a very big deal for you. So looking at that 500% improvement on natural gas in the Marcellus and Utica, I always like to say, let's look at the Marcellus and Utica because it's such a unique situation. And the way I like to do that is to cut total production from the Northeast and split it from everything else in the United States. This is everything else in the United States. Total production, lower 48, everything else in the United States dropping about 5 BCF from 2011 to 2016. So if total production is up, what must be happening? Yep, that's the Northeast. Just absolutely a skyrocket. That's on the right-hand scale, by the way, up from less than 5 BCF a day, up to more than, well, it's about 22 BCF a day. So the amount of gas that's coming from the Northeast is just absolutely astronomical. That's one of the reasons we have prices so low today, even though, of course, weather has had a little something to do with it. It hadn't been that cold a winter up to now. So what happens next? How does this all play out? Well, to answer that question, you need to know something about what is going to happen to, forgot. One last thing, one last line on this slide. That is demand in the Northeast. So big deal. What happened at the end of, the middle of 2015 is that total production in the Northeast grew greater than average annual demand in the Northeast, making the Northeast a net producing region. So that's a big deal in terms of Northeast pricing. So now to go back to where I was before, what's going to happen next? Well, like Howard said, you got to have a view on prices. And at RBN, we like to do price forecasts as much as anybody else. Unfortunately, we don't believe our price forecast. And for that matter, we don't believe anybody else's price forecast either. So in the time-honored tradition of all consultants, we use scenarios. So we're going to pick 3 scenarios. We're going to call them growth, cutback, and contraction, high, medium, low. With the growth forecast, assuming that we're going to get back up to $45 in 2016 on average and going to get all the way up to $60 by the time we get out to 2021. The fact that that should be our high case right now is just mind-boggling. And then on the low case, $30 getting up to $40, so something like what a lot of people tend to expect, and then the forward curve is somewhere between the red line and the yellow line. That's natural gas, so same sort of thing with natural gas prices getting up to above $3 this year, up to $4 in the growth case. Again, nobody may believe that, but let's just see what happens to production if that were to happen, and then the contraction case down at just a little over $2, getting up to about $2.50 by the time we get out to 2021. So what we're going to do is we're going to work through producer economics based on those forward curves. But we also ought to look back at what's happened in the past. So we're going to drop back and say, what happened back in the good old days when crude oil was 21 bucks? Or I'm sorry, crude oil was 100 bucks. And in order to do that, we'll take those same price scenarios that we were looking at a few minutes ago, but I have to put on them at a different scale because they wouldn't fit on those graphs that we were just looking at. So that's what crude oil prices looked like in July of 2014 when the front month was 100 bucks a barrel. And remember, we were in backwardation at that period of time. Prices in the forward curve were falling down to about 85 bucks. Then we're going to fast forward to May of 2015 when the forward curve was 50 bucks and 285. So we're going to look at production economics on all of those cases. And we're going to do the same thing on gas. Those are the same scenarios that we looked at a few minutes ago on gas. That's the forward curve back in July of 2014 for gas, and that's the forward curve in 2015 at the same, on the very same day that we had those crude oil curves. So that is history. That's a $100 case, a $50 case, and then our 3 scenarios that we have there. So as you can imagine, there's a big impact for what happens to producer economics depending on which one of those price scenarios that we're on. But there's 2 other variables changing. In order for us to be able to look at producer returns, not only do we have to look at price, we have to look at what's changed with 2 other variables, and those 2 other variables are extremely important. Number 1 is volume. How much volume does a given well produce? And number 2, what is the cost of that well? Those things have changed just as dramatically as prices have. Well productivity. This is Eagle Ford type curves. Again, this is our EIA numbers out of a report that you guys did, I think it was last Thursday, showing what the type curves look like for each of the major basins. It's a great piece that these guys did, and so those are the numbers straight out of that report, which basically says that the initial production rates for the Eagle Ford were somewhere around 100 barrels a day in 2010. Now they're up to approaching 450 barrels a day. That exact same productivity report improvement that we looked at a few minutes ago out of the DPR in the first place. Most of the major basins are seeing that exact same kind of improvement over time in the volume that comes out of the well. If you drill a well and you get 2 or 3 times more volume than you did 3 years ago, then obviously the economics are a heck of a lot better. Drilling and completion costs, exactly the same thing. This is for the Bakken, the Permian, and the Utica. Versus 2014, drilling and completion costs are down by an average, or were down by an average of about 25%. Different basins, different rates of decline, but down by about an average of about 25% from 14 to 15, and an average of about another 10% from 15 to this first part of 2016. So costs are way down. Volumes up, costs down, prices down. What does that mean to economics? So let's just fast forward through these economics, and you guys are going to have copies of the slides, so I'm not going to do a lot of detailed discussion about these, but what does it really mean? Back in 2014, crude oil prices were $100 on that forward curve and backwardation that we were looking at a few minutes ago, natural gas at $3.85. Crude oil rates of return were in the 40s. Natural gas liquids rates of return were in the 30s. And dry gas plays were in the low teens and sometimes in the single digits. Now, notice, if you would, up there in the Marcellus and the Utica, we have 2 different rates of return up there. The reason why is that prices in that region are extremely low if you're stuck with taking prices in that region. A lot of producers have pipeline takeaway capacity out of the region, and therefore, if they're lucky enough to have the pipeline capacity out, they were getting the rate of return at the top. If they didn't, they're getting the rate of return at the bottom. So those were the good old days, 2014. Fast forward to 2015. Now crude oil price is cut in half, $50. Natural gas down to $2.85. But remember, we had costs coming off hard, and we had volumes increasing. And when that happened, guess what? These guys were still making money. Now, when I'm saying making money, these are half-cycle rates of return, so I'm not including all the cost of buying the leases and everything else that's plugged into these things. Are the producers better off drilling than not drilling if they have the money to do so? These numbers say yes. So that doesn't mean they're going to like their financial statements. It does mean that they're better off drilling than not drilling. Wet gas plays in the 20s, 17, so on and so forth. Dry gas plays in the 11, 10, 17 type range. So in other words, last year, you could still make money at $50 and $2.85 gas. 2016, $45, that's the $3.25, that's our growth scenario. So this is this year's cost, this year's type curves, this year's prices. If you assume this growth scenario of we're back up to $45 and $3.25, everybody's still in good shape. What happens if we're on one of those lower scenarios? Well, here's the $45 case, and here's the $38 case. So at the $38 case, we're still in the positive double digits in crude oil. We're in the positive double digits or single digits in natural gas and natural gas liquids. Only if we get back to to the $30 case and the $2.10 gas scenario, which is close to where we are today, do we get down to single digits for crude oil, but not zero, not below zero, not if your drilling costs are down, not if you've been able to get your volumes up and you have a way to get this stuff to market. Single digits for wet gas and low single digits for dry gas. So you got to be in the right place. This is not traditional stuff. This is all shale drilling, and you had to really hammer your drilling and your service providers in order to be able to get prices down that much. But if you did, That's the rates of return that you're seeing. One more time, that doesn't mean you're going to like your financial statement. It does mean that the economics of these wells don't look so bad. What does that mean for crude oil production? We do our 3 cases out on this thing. So if crude oil, if we're on that growth case and things still look good, we get up to 10 million barrels a day by the time we get out to 2021. That's an increase of 160 barrels a day for each year. If we're on the contraction case, because of traditional production falling off, because of so much of the volume falling off, we still have a decline of 225 barrels a day in that low case. But the main point there is it doesn't fall off the face of the earth. It declines, but it doesn't decline down to the level of any more of where we were a couple of years, or 2-3 years back. Natural gas production, same thing. We were increasing at a rate of 2.8 BCF per day per year up until the shale thing really kicked in, 1.2. Since then, I'm hurrying, Frank, cutback scenario is about flat, and contraction scenario is a decline, and this is lower 48 down to about 60 BCF a day. Again, it's a decline, but it certainly doesn't fall off the face of the globe. So, last thing to mention, and that, so where could this go? So my logic is that if we don't drill these wells, we know where these wells are, we know where the production is, and if we don't drill these wells effectively, it's like hydrocarbons in storage. And if prices go back up, those wells are going to be produced. And therefore, what we are in is a trading range. If prices go up, economics on these wells are going to improve. When the economics improve, volumes are going to come back and push prices right back down again. Well, we've seen this before. It did happen before. I was a trader during this point in time, back when I worked for Texaco. I had a long position in the market, and I was not a happy camper. So what happened? Prices dropped from the 30s down to $10, and then came back up to $15, and for the most part, except for Operation Desert Storm, which didn't last long, stayed in that band between $15 and $22, a $7 range, for 14 years. Could it happen this time around? I don't know, and certainly not at that band, but you multiply that price right there by 2, and I can build you a case that that's exactly what we would see. So conclusions, we've entered the next phase of the shale revolution, shale 2.0. Producers have to deal with the situation. Productivity continues to improve. Even with today's low prices, some producers are economically better off drilling rather than not drilling. That's assuming, of course, if they had the cash to do so. So if they don't drill, then somebody else is going to pick up those properties and drill them. Crude oil prices could rebound to $40 to $60. Gas prices increase to $3 to $4. Then production growth is going to come back at lower prices. Then they don't. But there is no guarantee that those lower prices are going to result in higher prices, because whenever production prices kick back up, production is going to kick right back up again. And by the way, Frank told me that I could plug my book, so my last slide is a book plug. If you want to know more about this, it's only $14.95 or something like that on Amazon. Thank you very much.
Well, now I have to bring this more onto the world stage. As last year, I think a lot of the things that you're hearing from Rusty absolutely reflect my view and what I think are key drivers. Howard was saying, well, there is the rest of the world, and obviously we have to look at it all. But I go back to the beginning of my talk last year, that it really is all about shale. That's what's different in this world. There's a few other things that we need to pay attention to, but in terms of the market dynamics and the state of the oil market today, it's about shale. If we could have the... Oh, do I have to hit a button here? No? Next presentation?
Yeah, you have to do Rusty's slides.
I can actually do that, but no. Is there... Oh, there we go. Thank you, Mariah. So as I said, we need to remember what caused this and whether or not these are still relevant or not. How are the roles of the key players changing? Obviously, we saw one OPEC when it started. We saw a different OPEC as of November 26th of 2014. Do we see back to the old OPEC now as of Qatar in February of 2016 or not? I think not, and I think most of us would agree on that. So where are we in this overall adjustment process? I think the term lower for longer, that if we didn't invent it, we were pretty early in using it at Energy Intelligence. But, you know, how much lower and how much longer are obviously key questions, and I think I'm a bit on Rusty's side. Maybe 14 years is a little long, but it isn't 14 months, and it certainly isn't 14 days. The global balances for 2016, I think I'm a bit on the pessimistic side compared to some of the other guys, and I'll show you some comparisons. And I'll talk a little bit about shale, but I don't have to do too much, Frank, because I think that's been really well covered. So I'll just reinforce a couple of points that were made by Frank. Then the other question that's lurking in the background, and I'll bring it in a very sort of tangential way, but COP21 and CSIS has done a lot of very good work in sort of bringing out opinions on that. I just focus on one thing, and that's, did it change the way that Saudi Arabia thought about its resource in the long run? I happen to think it does. They haven't stepped up and said that, but that has a huge impact on the way that they behave in the medium term. And then what outside influences affect the market, which we need to keep in mind. You have a bio already. Now, let's go back and remember why this price decline happened. It wasn't because OPEC had decided to leave its market share or leave its market management role as a production cutter. It happened because of the birth of the shale era and its sort of coming of age in 2012, 2013. So by the end of 2014, just the size of the shale resource was becoming a major issue. There are a number of myths out there, which I mentioned last year, that this was not the result of the $100 prices. This was not the result of anybody finding anything. This was not the result of new technologies. I mean, they all played a role in the speed of things, but it really was a change in how geologists thought about their job. A good geologist was a guy that knew how to figure out where the oil stopped. He didn't care where it started, where the source rock was. That changed with the shale era coming of age. Now source rock is absolutely essential to understanding the future of global oil markets as well as the U.S. So this is a very large resource, but it's also a very new resource in terms of its commercial value. Saudi Arabia looked at that, and as I said last year, they couldn't change the knowledge of the resource base. That was a cat that was out of the bag. So they chose to try to change the economics. And that's sort of where we are in things right now. Well, how are people doing? Obviously, I liken this to an opera or a ballet, that there's a dance, and Saudi Arabia is in the role of prima ballerina. A different role, by the way, for Saudi Arabia. They like being in the shadows, and now they're Mohammed bin Salman, sort of in the lead of this, is taking a lot of the spotlight. Is there going to be an agreement? I don't think so. But is there a lot of pain in this market that would maybe cause an agreement? Yes. So it's a horse race at this point. The other thing that's going on is that with the end of each of the act of these various dances of who visited who and whatever, there is a round of applause from the bears who are still pulling on Frank's slide. and there's a little bit of jump up in the price of oil. Well, maybe that's what this is about. Just getting a little bit of relief from the low oil prices in spits and spats, but not giving up on the overall market share strategy in a way to be sure that 25 years from now that Saudi Arabia isn't ending up with the biggest stranded assets in the history of the planet in terms of unproduced oil reserves. Let's look at the size of the cut that actually is required, which we haven't done yet in these presentations. By my numbers, it's 2 to 3 million barrels a day just to take care of the daily surplus. And I'll show you the quarterly numbers in a couple of slides on. But on top of that, we now have somewhere between 500 million and 1 billion barrels of oil that has gone into inventory. Some of that's dead oil, the strategic reserves and some of the pipeline fill and stuff like that. But I think we're still talking about a cut on the order of 5 million barrels a day to fix both parts of the problem, the stock overhang and the daily imbalance. Is that a number that OPEC, even with non-OPEC help, can do? It's a very challenging thing. So this freeze is not even close to getting that getting done. And it continues to build a surplus, which was pointed out before. So let me move on, actually. I know we're a little behind time. So where are we in the process? And then I'll get to some numbers, which I know a number of you love. Obviously, we've seen the price decline. This sort of twin-pronged strategy that's developed out of it, that it's not only affecting the economics in the patch, it's clearly affecting the level of financial pain that's in the market, both for producers and for countries. Not nice to be in Venezuela these days. That means that there are two options, or two successes that you might see for the Saudi market share strategy. One is you drive enough production out to get the daily balance and start bleeding out stocks, and the other is you get people to the table to agree on a production cut. Whether that cut then works is a second order thing. Right now, it's not even the existence of the cut, it's the discussion of the cut, the possibility of a cut that moves markets. And having spent 15 years on Wall Street, it doesn't matter if it's true or not. It matters whether the other guy thinks it's true, and it matters how fast you get your money into the market versus the other guy. That's how you make money. I have a friend, Buff Brown, that had told me early in my career, it's very dangerous being smarter than the market, David, because you can lose a pile of money that way. The other quote, which I think I mentioned last year, I like even better because I did it. I was on the Crude Oil Advisory Committee in the 80s, and I said that the NYMEX is the most efficient misprocessor of misinformation in the history of Western economics. You remember the number of times you heard the king of Saudi Arabia is dead, but he isn't, and prices go up. Well, why wouldn't they go down? And yet, if you tried to invest in the truth of either of those things, you just lost money. So something to keep in mind. And as we know, the slides are there. Well, let's look at what these balances look like. And it isn't all about prices. There's a lot of other stuff that is going on here. But you'll see that I have a sort of mid-level demand forecast. Actually, this is my colleague Ian Stewart that puts those numbers together. And we'll look at kind of how we compare to other people in a minute. But clearly, I am an optimist that is in the Braziel category on the supply side for all the reasons that you just heard about. So we looked at a surplus last year that was over 1 million barrels a day in the first quarter and grew to something between 2 and 2.5 by the fourth quarter. This year, we start off with a surplus that's well over 2, and it just continues throughout the year. And part of that, I think, is Rusty's story about there are people that are still making money. And I think we tend to focus way too much on averages and particularly on the bottom end of the producer spectrum. The dumb money, I think somebody might have said before. And I've been using the term economic Darwinism in the shale patch, and we've talked about the shale bomb being about to explode, which is the bubble scenario that, again, that Rusty had brought up. But the important thing is how many of those companies, or how much of the production from the shale patch comes from the lower tier of the financially challenged companies, and more importantly, in a way, is how many of the big banks are in major exposure. And that's still kind of up in the air, because remember that oil prices are a huge factor in figuring out what the reserve base is for reserve-based loans. And a lot of this stuff is reserve-based, and those are still being, the redeterminations could get ugly. But in a way, the banks don't necessarily want to see how bad it is either. So they're willing, with the term kick the can down the road certainly was applicable back in September, and it may be applicable again when we get to April with some of these redeterminations. And if we do lose a few of the dumber players, let's be frank about it, in the shale business, that's good. And there is a process by which it's called economics, by which people that do badly tend to lose their assets to people that do better. And we're waiting and waiting and waiting, and it's sort of, I'm calling it now slower for longer, how this whole bankruptcy and asset reallocation process is going to work out in the market. It certainly is not going to happen very fast if the people involved in trying to improve their level in the capital stack, as they call it, in the bankruptcy terminations are just waiting for that price increase to come and bail them out. And I talked to a bankruptcy legal shop a month or so ago, and I said, my question is, what's the buy side of this market looking like to you? Are you seeing the private equity guys? Are you seeing some of the hedge fund money taking a look? And he says, I'm not seeing anybody. Well, I know there's been a little stuff going on, but as a major transfer of shale assets from the economically or mentally challenged, let's call it, people in the business to deep pockets, smart investors, you end up with a whole different picture, a picture that looks like the upper curve in Rusty's presentation. The same technology is going to be in play. The same people, if it happens relatively soon, are still going to be available. The same locations are still probably going to be quite friendly. It's certainly the Eagle Ford is where, if I were God, I would have put the shale there, because that's a great place for shale. The refineries are right next door. The people love you. The state is very hands-offish. It does its job, but it doesn't do it in a particularly disabling way. So Permian's a little bit different, but the Permian is also a big mix of conventional and non-conventional stuff. So anyway, there's a quick picture of what I think the overall supply-demand situation is. And I'll share with you also kind of a look at, it's not just the U.S. In terms of the adjustment that's taking place. It's a fairly broad set of countries that are being affected not only by the lower oil prices, but also by a whole different set of circumstances, be they sanctions, be they just geological age like Mexico, the sanctions for Russia, the geological age again for China. I've had a feeling for a couple of years that Daqing has just been held up by mirrors. That's an old field. It's been very heavily, it's not a field, it's an area, but the reserves in that area have been abused in almost Sametlar fashion. Bob Eagle isn't here, but he might be able to tell us some stories about that. And it's just, you know, it's going to hit in a bunch of places, but when you get to the end of it, I still have 500,000 barrels a day of growth in non-OPEC supply this year, and I'll show you in a minute that puts me in a fairly different group. And as I said, the numbers are there. if you look at who's thinking what about oil, and you've heard a bit about this before, that I have on the right is a September table that we did for Oil Market Intelligence, which I edit, and then we have a recent one. And you'll see that we were the only ones, and I should say I, because I do the supply work for OMI, we had some growth, and I actually have a bit more growth, because I, as Howard and Rusty, am a bit more optimistic about the Gulf of Mexico in terms of the completion of mostly completed facilities, but I'm quite nervous about the future of the Gulf. We were talking in the green room, if you will, beforehand, that the oil service people are telling me that there is literally no exploration drilling going on in the Gulf of Mexico. So what we have in sort of in the queue to be produced, those, and not all of those, as we know from Buckskin being delayed if not canceled. But you know, the thing that I have, why I'm in this position as opposed to the EIA and the IEA and OPEC, is because of waiting for the information that the declines are really there. And I saw one set of pictures from Howard, and I saw a completely different set of pictures from Rusty in terms of the relation of the productivity gains and what their impact is on the overall production level. This is on the shale component. And so I need to wait to be proved wrong about how deep those declines are. We do a conference every year in London called Oil and Money, and a number of you have been regular participants in that, like Guy and some others, and Frank. And at that meeting, Mark Papa, who for years was running EOG, one of the really successful companies, told us that we were going to have a 700,000 barrel a day U.S. year-on-year decline by January. And I had to deal with that. I have huge respect for him, and he's out there in the business. You saw that what we were using to show you what's going on were EOG. That's the picture of the good side of the business, and it needs to be looked at. Well, that didn't happen. It doesn't mean that it isn't going to happen in the future, that things aren't going to come down, but as long as you see the nuts and bolts of the productivity of the new wells, and the wells that are drilled but uncompleted lurking behind there, you're going to still see oil production growth. And that's why I'm there. Well, last year I made a forecast, and I'll show you the forecast in a minute. And I said it was my forecast. And then as it looked like it was going to be right, it all of a sudden became the EIG forecast, and they sent me out to show people what I thought. And almost all of them said, well, what about 2016? I said, well, I can't tell you about that yet. I have a forecast, and here it is, but my company doesn't know if it's going to be right or not, so it's not sure. So I have to say that that's the David Knapp forecast of oil prices. And it's kind of sideways. You know, we went from almost $100 to $50 for the Brent price, and similar declines, you know, basically losing half of the value. And now I see it going more or less sideways. But this is on the left-hand side. It's a very choppy type thing, and I think that's volatility. And one of the things that we didn't talk seriously about was the shape of the forward price curve. It came up in a couple of slides, but it's absolutely critical to clearing the market every month to have a place for the oil that doesn't fit with the supply-demand balances to go. If you have a sufficiently upward sloping forward price curve, the contango is enough to justify on-land storage, and ultimately probably it's going to need to be floating storage as well, then that oil is going to go away. As soon as you flatten that curve, the oil comes back out, and the front end of the curve goes down, and then the economics come back, and then the oil goes back in. And that's what I see it like a fish going through the water this year, up and down and up and down and up and down. And so, but you end up at the end of the day, you're still in the low 30s. And a lot of people say that's just too low. The economics require 40 or 50 or 60. I had a guy up at the Canadian Energy Research Institute saying, well, prices have to go up. And I say, why? And he said, well, because of the pain. And I said, whose pain? He said, well, just look around. Venezuela's pain, Iran's pain, Iraq's pain. And I said, and since when does Saudi Arabia treat pain in any of those three places as a negative? I mean, part of their game might in fact be about the level of pain within OPEC, and hey, maybe let's put Russia in there. Now, they're somebody who isn't our best friend either. So when you look at the strategy, there are the geopolitics that you have to consider. And if you look at the price forecast that I actually made here is the second set of those curves, and it was basically every month I was making a little update on the forecast and, you know, handling the blips. And all those blips did basically was allow some of the producers to hedge at much more fun levels than they have now. And it created a bit of fluff on the upside, and boom, it came down. So these were all these temporary things. The bank redeterminations in September that I mentioned also thought, and I thought there were going to be some geopolitics. There are no geopolitics at this kind of a surplus. Geopolitics matter, but, you know, we say the Middle East has never had a higher degree of geopolitical risk than it has today. I absolutely believe that. That makes for a nice day's discussion and all that, but guess what? The production for the Middle East has never been higher than it is today. And the rest of the world has plenty of oil too. So do I care about the geopolitics? I do sort of in an academic way, but I don't really care much about it in a commercial way. As soon as the market gets tighter, we're going to be talking a lot about Sudan and Yemen and Syria and other stuff, but not at this kind of a surplus. Well, if we look longer term, and this is sort of a combination of a couple of themes that you heard earlier, from Howard in particular, that there's another fact that we kind of talked about, but I think it needs to be reinforced. Finding and development costs are much bigger than operating costs, period. So the adjustments that you get short term in oil markets from shutting in fields because the costs have gotten so low they're below operating costs are very much smaller than what you lose in cancellation of longer term projects. Those that have already started that don't have much completed, or those that you haven't done yet. The entire deep water, a good part of the Arctic and all that. Well, if you don't get that oil on the non-OPEC side, you're going to end up with a deficit probably as early as 2019 or 2020. Maybe a little bit in my numbers in 2018. But I have a very soft expansion path for Saudi Arabia in this. And if the other thing I said about the long-term part of the Saudi market share policy, being sure that oil has a market share, that we're going to keep it cheap enough, we keep our role as a factor of global production, we keep our particular role in energy markets against other fuels, we keep our role within the oil market against other producers, that is what fills that gap. Can the Saudis do it? The Saudis can absolutely do it. They have the ability. There's also a lot of rigs in Saudi Arabia, and we don't think they're all drilling for shale gas. You know, I think they're preparing to bring on more capacity and to use that capacity, and that's what fills in this gap. Do they do it without an impact on prices? Probably not. So I think that there is an upside for oil prices as you get towards the end of the decade. Well, as I said, I will skip through some of the shale, and the slides will be available. I have a view that the Eagle Ford is probably not as bad off as we think it is. And there's been a long-term discussion among some of us about, I love the drilling productivity report. I absolutely agree with what was said by Rusty, and I thank Howard for the work that gets done, and I'll be talking to them tomorrow. But the idea of not fully segregating the shale stuff, the stuff that comes from shale zones, the Eagleville field, the Eagle Ford shales, and some of the other shales, sugarcane and Briscoe Ranch, means that what we might be seeing by measuring things in terms of shale counties is just an accelerating conventional oil decline. And there's a lot of stripper wells in East Texas. Texas has more stripper wells than anybody. And those are economics that are really being challenged. Now, there is a lot of inertia in the termination of shale production, just reclamation costs and various other things that will keep things on for longer. Uncle Charles needing his 12.5% or whatever in some of these small operations. So I think that the Eagle Ford has not gone down quite as much, but clearly it's gone down. And remember, my price forecast was higher than what we've now seen for most of this year. So I'm continually making adjustments, but I'll go back to what I said before about I need to be proved wrong about the continued growth in non-OPEC supply, and in particular in where the U.S. is. These are, well, actually, let me go back. This is just to remind us how change causing the whole shale revolution has been for the U.S. You look at what happened to a lot of these states. We were in a long-term decline. A bunch of these shale states have now stepped up, and this is something I just put in to sort of keep it in mind. And then if we look at the U.S. production mix, the only thing I'd add to what was said before is that besides the main shale states, and these are mixes of conventional and shale production, it's Gulf of Mexico and NGLs. We think the NGL market is going to continue to look pretty good, and so I'm encouraged that that Rusty sees a bit of that going on as well, and at least in his middle scenario. The only thing on here that's of note at the bottom is to notice the difference between the Bakken, which is not shale, it's actually conventional carbonate deposits, but it's being produced like it was shale. So you can segregate that out, and there isn't very much of the other stuff, but it's going down, and the Bakken is still going up through this year. If you look at the Permian part of the New Mexico, it's even more stark there. So, and then you'll see that things do turn over in the picture on the bottom right. I won't talk about that. I won't talk about New Mexico or Colorado, but let me just finish with the idea that there's a whole lot of things going on in this oil market. No oil market is an island. That paper markets have changed a lot of things, that certainly what you see in daily moves in the oil market have to do with market psychology. We see asset allocation things going on with this. Do you like oil better than other commodities? Do you like commodities at all? Basically not. Where do you put your money? And that affects it. Physical market interactions are becoming much more intense. We are the global village and all this kind of stuff. The speed of everything. The Flash Boys is a great book, Michael Lewis's book. I mean, it's all about speed, and things change very quickly. And another rule of that is I think they also don't change particularly permanently. So you get a lot of temporary episodes and things. And a few other points on that. We try to track the relationships between currencies and oil, and between the S&P and oil. Isn't this interesting? Low oil prices and declining economic growth prospects. What happens there? Do we rewrite the economics books? No, it's about the complicated linkages and interactions within oil and markets in general that cause these strange correlations to happen. It also is about the speed with which oil prices decline and the volatility around those declines, that those are all adding to uncertainty, which makes business decisions more difficult, which then cause economic problems, as well as the low oil price, which may be having demand effects, but they're not big enough to cover up what else is going on. Physical markets more complex. The shift to the east has changed the players, the NOCs, IOCs. There's a whole day worth of stuff to do on that. And the financial market drivers at times dominate what goes on in the physical markets. In fact, mostly they dominate. So when you see changes in the price of ICE Brent or in the WTI NYMEX price, are you looking at real world, or are you looking at psychology? And mostly it's about psychology. And I've left a couple of slides here which give details on supply, demand, and whatever, and then I'll go back here because I don't like that guy anyway.
That's where John's going to start.
Yeah, and sitting in the middle of all of this, segue, is the poor refiner that has to deal with not only the complications in the crude oil market that you've heard in the first three talks, but there are product markets. There's a global surplus of crude that has become a global surplus of products. There is now a new exporter of products in the world. There's actually several of them, but the U.S. and Saudi Arabia have changed a lot of the dynamics. So let's hear a little bit about what refiners are up to. I've moderated before.
So I promised you content rich. Since we started a little bit late, John, we're not going to take away from your time. These are excellent discussions, and then we'll just pause for questions at the end.
Well, I'll try to be very efficient with our time. Frank, thanks for inviting me. Thanks to you all for attending and for your attention. I guess we'll get this thing loaded as soon as we do. I'm going to talk about a part of the business, the segment of the petroleum business that actually makes money. Can you hear me? Did I not get it? Oh, down here. Oh, I got to get. Let's see.
Keep going down.
Oh, next one. Oh, there we go. Let's go back. Okay, I'm actually going to talk about a segment that actually makes money, and let's get on with that. We've seen and heard a lot from this guy in the last few months. We're probably going to hear a lot from him going forward. We know he loves winning. He thinks the U.S. isn't doing enough winning, but the fact is the U.S. refining has been doing quite a bit of winning lately, especially against our competitors, Japan, Europe, and South America. And I'll kind of get to the basics. What determines who wins in the game of refining? Obviously, the refined product supply-demand environment is important. I've color-coded this, so red means something refiners themselves can't do a whole lot about, green something they can do something about. Can't do a whole lot about refined product demand growth, both regionally or globally. They're kind of stuck with whatever the market gives them. They can't do a whole lot about the competitive environment, the supply of refined product, but they can do something about it. We've seen here in the last 2 or 3 weeks fairly timely responses from refiners in the U.S., primarily in the Midwest, some on the East Coast, even on the Gulf Coast, and trimming back their run rates to respond to growing seasonal product supply. And I do think it's seasonal. I think we'll work through it. Seasonal product growth and reaching tank tops in certain levels. What they can do is they can make investments to shape their product slates to make them more valuable products. They've been doing that over the last few years, trying to make more diesel as diesel is more in demand. Maybe they'll have to make more gasoline as gasoline growth has returned. They also can make investments to try to access markets with better supply-demand balances, more attractive markets. Location is also important as far as the feedstock supply dynamics go. Refiners that are located close to these light tide oil basins that were growing, and then you got to the situation where you couldn't even get that crude out of the area. They experienced double-digit discounts in their crude supply costs compared to guys on the coast, compared to international refiners. There's other feedstocks as well, not as important as crude, but access to cheaper intermediates. Gulf Coast refiners have ability to trade intermediates. That's a plus. Access to cheaper ethanol, access to ability to blend natural gasoline into the gasoline pool. Those are all pluses. What refiners can do is make investments to process the changing qualities of the crudes that they're going to run. They've done that in the last several years, be able to run the very light condensates that are coming out of the Eagle Ford. Before that, they made significant investments to run the growing volumes of Latin and Canadian heavy crudes. They can also make investments to improve access to crude. East Coast refiners didn't have direct access to some of the light tight oils. They made significant investments in rail facilities. Operating costs are an important line item in any manufacturing operation, and certainly natural gas is the most important variable cost in a refinery. It's used to generate process heat. It's also used to generate hydrogen for refining processes. And what we heard today, and saw this shale gas boom in the U.S. has been a real boom for U.S. refiners, much cheaper access to gas than guys in Asia that have to bring in LNG, guys in Europe that have to bring in LNG and expensive Russian gas. Size is important. Economy of scale is always important when it comes to cost. Refiners can do some things about that. A lot of the merger acquisition activity we've seen has been largely justified by being able to reduce redundant costs, both at the refinery level and also at the corporate level. They can also invest in projects to increase energy efficiency, increase operating efficiencies. And certainly the refiners that do a better job of managing costs are more successful at the game than the guys that don't. Finally, regulatory environment. Certainly guys in Washington care about that. It varies, not just from country to country, but from state to state, and even sometimes from municipality to municipality. Again, location. The refiners can't do a whole lot about where they're located. These regulations can impact demand in a negative way, can increase costs, they can affect access to supply, they can impact their ability to execute projects on a timely and cost-effective basis. We have a lot of people here in, buildings full of people on K Street to try to mold and shape those legislations to at least limit the potential disadvantages to refiners. And sometimes they're successful, sometimes they're not. Wise decision-making in terms of complying with the regulations that are in place can differentiate between a winner and a loser. Also, making wise investments decisions to make compliance more cost-effective. Just looking at demand, and I've seen a little bit about that from Howard. And obviously, the developing countries, that's where all the demand has been in the last 10 years. We've increased total world refined product demand by 9.2 million barrels in the last 10 years, and that includes the impacts of the global recession in 2008 and 2009, which where we had 2 years of decreased demand. Almost 14 million barrels a day increased in the emerging economies, and the developed economies lost 4.5 million barrels a day of product demand. And 1.4 million barrels of that was the U.S.'s share of that declining demand. Now, we've seen a bit of a change in the current low price environment. Refined product is elastic. It responds to low prices. 45% of the, according to Howard's numbers, 45% of the product demand growth in the last year came from the U.S. and Europe. And we've seen slower growth in producing countries, where the low oil prices have negatively impacted their economies. On the U.S. on a regional basis, kind of the same story. Most of that 1.4 million barrels a day of declining demand in the U.S. in the last 10 years came on the East Coast. More of it came as well in the Mid-Continent and the West Coast, whereas the Gulf Coast and the Rocky Mountains actually showed positive, although slight, but at least showed some positive demand growth, partially aided by a strong energy industry in those areas. Again, similar to what happened worldwide, the consuming parts of the country showed the greatest demand growth here in 2015, responding to the low prices, the East Coast and the West Coast, and more subdued growth levels in the Mid-Continent and the Gulf Coast, and actually decline in the PADD 4. Again, partially related to the impacts of a slowdown in the energy business. You build refineries where the demand grows generally. And you generally build capacity to try to match that demand growth. And we know over the last 10 years, we've been fairly well matched that 9.2 million barrels a day of demand growth by building about 11 million barrels a day of additional refining capacity. And when you consider normal utilization rates, that's an 11% increase in capacity over that 10-year period. As you'd expect, most of that came in areas where demand was growing. Asia, 80% of the capacity growth took place in Asia. Middle East showed strong refining capacity growth. Many both grassroots refineries and expansions of existing refineries took place. One exception is Latin America. Even though there was strong demand growth over the last 10 years in the Latin American countries, actual capacity went down by over 200,000 barrels a day, and we considered utilization rates, that their effective capacity went down even further. Now, for countries where demand was falling, in Europe and in developed parts of Asia, they had to rationalize capacity. They lost a significant amount of capacity in those regions in the last 10 years. The one exception is the U.S. Despite demand falling in the U.S., as it did in Europe, as it did in developed Asia, we actually added over 900,000 barrels a day of refining capacity. And so why is that? Why were we went against the trend? The big reason is we increased our level of competitiveness compared to we were winners, as the Donald would say. I think underlying the ability for U.S. refiners to become winners has been really a free market in the oil business. And maybe we don't think so at times, but relatively economically and politically stable. And it is compared to, it's all relative, right? And it wasn't always the case. We had some pretty misguided energy policies in the 1970s where we controlled the price of crude oil. And by the early 1980s, we had a very bloated refining system in the U.S., over 300 refineries operating. Average capacity was less than 60,000 barrels a day. A lot of them were living on basically subsidized crude set-asides. When Reagan deregulated the energy markets totally in 1981, all of a sudden, and I think finally it was finalized in 82, the refining industry went through a long, and I heard the term Darwinian kind of process, and it did go through a real survival of the fittest kind of process over the next, really 25 to 30 years. And that was, in the end, good for the refining industry. 180 refineries shut down, so it wasn't good for the people who worked there. But in the end, what we came up with the refining industry, even though we shut down 180 refineries, we have a capacity that's significantly greater than where we were in 1982. It's evolved into the most advanced, complex set of refineries in the world. We have 4 to 5 times as much delayed coking capacity, ability to upgrade resid as refineries in the rest of the world, 2 to 3 times as much total upgrading capacity, ability to take gas oil and resid and turn it into gasoline and diesel as refineries in the rest of the world. We can run heavier and more difficult to process crudes and turn them into more highly valued products at higher throughput rates and higher reliability rates than anywhere else in the world. We also have the deepest and most talented set of labor pool, all the way from management, all the way through technical, down to the skilled and hourly people. And that allows refiners, allows refiners to run these refineries at higher reliabilities. It allows them to have lower operating costs despite high wage rates. Also allows them to execute projects at lower costs than anywhere else in the world. Almost without exception, you can build or add to or expand or make capital improvements at a refinery in the Gulf Coast cheaper than you can anywhere else in the world. And to put the final frosting on the cake has been what's happened in the upstream segment of the business. Low gas prices have been a boom to U.S. refineries. Lower crude prices relative to the rest of the world has been a boom to U.S. refiners. And just to take a look at the magnitude of that, as you can see from this shows the natural gas price and the average U.S. refiner, what he sees versus what refiners in Europe and Singapore see. And you can see throughout that shale gas boom era of 2009 to 2013, gas prices skyrocketed in those areas, especially in Singapore and Asia, where they're having to bring in high-cost LNG. And it actually went down, stayed below $4 per million BTUs, and stayed down below those levels through that whole period, increasing our advantage compared to refiners in those areas. Now, with the decrease in energy prices, there's been a compression of that advantage. It's still an advantage, but a compression. And if you look at that table there on the left, you can see how that translates to $1 per barrel operating cost at the refinery level. In 2013, U.S. refiners had anywhere from a $2 to $2.50 per barrel of crude processed operating cost advantage due to lower gas prices. That went down to, somewhere in a $1.50 range in 2014. It's gone down further to, maybe around $1, depending on where you're comparing it to in 2015. Crude price environment, lower crude prices also are a big advantage for U.S. refiners. Prior to the boom in domestic production, U.S. imported significant volumes of light sweet crude and crude overall into the complex. Brent, and this is Brent compared to LLS, dated Brent compared to LLS at St. James. Brent generally traded at Brent and Brent-linked crude, so it's really not Brent, but all crudes linked to Brent, traded at import parity on the U.S. Gulf Coast. That basically meant that LLS was priced anywhere between $3 and $5 a barrel above dated Brent. As we started displacing those imports and domestic crude started making its way in a greater way into refiners' crude slates, we had a period of time there from 2011 through 2013 where the Brent LLS spread was essentially zero. It was volatile, but it averaged right at, they were equal to each other. During that same time, regional crude differentials really blew out. WTI, Cushing rose to $20 a barrel below, being priced below Brent. Bakken, Canadian heavy, Rocky Mountain-based crudes. Refiners that could access those crudes made huge margins because they could get their feedstock at a huge discount because those crudes couldn't make it to market. As we built pipelines to the Gulf Coast, so U.S. Gulf Coast refiners could access them, that discount moved down to the Gulf Coast for some period of time. Now, as the crude price environment has changed, lower absolute crude prices, obviously production hasn't declined very much, but it's declined. Growth has stopped, and we've moved back to where, when it's volatile. LLS and Brent are trading at about the same level, depending on what day you look at it, and we're probably moving more towards an import parity level, depending on what happens over the next 3 years. All this has driven a huge change in the refined product supply balance between the U.S. and the rest of the world. U.S. is always the world's largest importer of refined products. By 2006, we'd reached levels, and this is a 6-month rolling average basis, these numbers, we'd reached levels where we were a net importer of 3 million barrels a day of product. With that increase in competitiveness, combined with that decrease in domestic demand, and that increase in competitiveness allowing us to access and take market share away from other world refiners, particularly European refiners, and to fill that growing refined product gap in Latin America that we saw, that has allowed us to completely reverse pattern, and we've gone from the world's largest importer of refined products to be the world's largest exporter of finished products and total exporter of products. A switch of 5.5 million barrels a day, which is huge. The U.S. is a big country. We got by far twice as much refining capacity anywhere else in the world. Dynamics are different in all the different regions. PADD 1 is certainly the most challenged, the East Coast, most challenged of the refining sectors. While the rest of the U.S. was increasing capacity, they actually lost some capacity. But they've stanched that loss by being able to access, making investments to access some of those light tide oils by building rail facilities. It's obviously still a very competitive market, and they're disadvantaged by the Jones Act. With crude exports liberalized, a European refiner can potentially get a barrel of crude from the Gulf Coast cheaper than a refiner on the East Coast of the U.S. PADD 2 benefited the most from the crude surplus, and refiners there experienced significant discounts, as we discussed. A lot of that advantage has gone away as pipelines have been built to move that crude further down the line, and it's also gone away in this lower crude price environment. PADD 3, if it was out there by itself, it'd be the largest refining system in the world. It's significant. Its prospects depend on what part of PADD 3 you're talking about. Guys that had best access early on to the growing Permian and Eagle Ford production and the Panhandle, West Texas and South Texas did very well. They realized some of those big domestic discounts. as significant midstream infrastructure has been built so that most of the PADD now can access those crudes. The big thing in PADD 3 is they've become very dependent on product exports. That's where the products are exported from. 35% of the refined products produced in PADD 3 go to export markets right now. PADD 4, very small, by far the smallest deal. They're advantaged in both the supply and demand standpoint. There's the only region where actually in PADD production of crude exceeds in PADD consumption of crude and products. They are also, have good access to the growing, or not anymore growing, but Canadian production, which had been growing, good access to the Bakken production next door. And demand had been pretty good and stable until recently, but limited room to do much there. Refineries are small and far apart, and any expansions would have been related to supplying regional demand. PADD 5, a lot of potential. It used to be the most profitable refining area in the country, and last year it was again. Very challenging environmental environment and regulatory environment. They've had declining demand until recently, and that has moved the region itself from being in a small deficit to being a small surplus when all refineries are running. The key is not all refineries run all the time, and we had major outages last year. The ExxonMobil Torrance facility was down for most of the year, still down, their CAT unit. And so they have significant gasoline shortage there. It's difficult to replace product. They have to bring it from overseas. It's not connected very well to the Gulf Coast. And in times like that, you can enjoy very good margins like we saw last year. Their indigenous production, and if you include Alaska also, is declining, and they have limited access to LTO production. Just last week, we heard that Valero, who was applying for a permit to build a rail facility at their Benicia refinery, that got turned down by the local planning commission. Like I mentioned, it's a challenging environmental regulatory environment, and that's going to always be a challenge for them. What's that meant for margins? The golden age of refining was that era that was kind of demand driven. There was, from 2005 to 2008 into 2008, where refiners experienced the best margins they've ever had. All regions in the U.S. did really well there. The financial crisis in the world obviously hurt margins and hurt demand. It was driven by drop in demand. But the golden age 2, the supply-driven golden age that took place from 2011 till now, was even better, especially for those refiners, as you can see in the Mid-Continent and in Rocky Mountains. 2015, even as margins had declined a bit, they were still very good, again, driven by strong demand, incentivized by low prices. U.S. West Coast, as I mentioned, had a particularly strong margins because of supply shortages there, refined product supply shortages. Margins have gone down so far this year. Now, this is a winter season. They typically go down. I personally think it's relatively temporary. West Coast is still strong. That Torrance facility is going to come back online in the next 2 months, and you can see those margins contract to some degree. The U.S., as I said, they've been winning. They've been winning against the rest of the world. Margins have been significantly higher than the rest of the world. They're significantly higher in 2015, even though you start seeing some pickup in demand in Europe. Here recently, they've contracted, partially because of these compressed advantages from the cost side and from the crude cost side. Looking at it from a sector standpoint, in the early part, and this starts from a 2013 base, all segments of the business did really well. Up until 2013, and from 2013 up until crude prices started falling in the second half of 2014. As soon as crude prices start falling, obviously the guys that have done the best, the independent producers, the green line, obviously did the worst and fell the quickest. It took a little, the integrated majors, they'd been moving towards being more upstream oriented. They also declined. Midstream guys kind of held their own from an equity performance standpoint until recently. By now, all three of those segments are below, on an average basis, below where they were in 2013. Only the refiners have done better, and they've taken a hit here in the last 3 or 4 months as margins have contracted to some degree. Comparing the integrated majors to the independent refiners, you can see that net income for the driving that growth in equity values has been driven by positive margins, which have led to positive net incomes, 30% growth in net income last couple years as crude prices fell and demand went up. Just the opposite is true of the integrated majors. They're so upstream focused these days that whatever profits they made in refining was more than subsumed by the losses they experienced on the production side, and their net income's down by 80%. That does include some special items. And by the way, the independents, that's the 7 largest publicly traded independents. The integrateds are the four majors: Exxon, Shell, BP, and Chevron. As I said, the integrateds have been moving towards getting rid of their refineries and going more towards the production side. That strategy worked well for them back in 2007 and 8 when prices were up. They did a good job. Over 80% of their earnings came from upstream. They did really well. In this latest production boom, 2011 through 2014, again, over 80% of their earnings come from the upstream side, less than 20% from the downstream, again, excluding some of the ancillary businesses and corrections and adjustments. But here in 2015, that's been completely reversed. Over 80% of their earnings came from what refineries they still had remaining. Again, that wasn't enough to compensate for their loss from the upstream side because they've become so upstream focused. So some final thoughts on some key issues. Lower for longer is, I don't know how, that's somewhat of an overused phrase, but it sounds like everybody is in agreement that we're going to be there. We're going to be lower for longer. It's pretty clear that those aren't good for the upstream segment, for the midstream segment. It's more complex for the downstream segment. There's positives. Low prices incentivize demand. Low prices also could lead to higher margins on products that don't track crude prices, things like asphalt, petrochemical feedstocks, and lubricants. But most of the bang you get for that is as prices fall in the first year or two. So you can get a little less bang, demand bang out of those low prices as we go forward, as prices do stay lower for longer. There's also a negative. You have compression of crude benefits, crude differential benefits, as we've seen already, as natural gas cost benefits versus the rest of the world. And it's regionally specific, in regions where product demand is somewhat related to the health of the oil industry. That's bad for refiners as well, and also bad for their ability to access crude at bigger discounts. We've seen that not just in the U.S., but across the world. The lifting of the crude export ban, almost all the time in the last couple of years that I spent in Washington, it was related to that issue. A lot of people did a lot of study on this. It was a big deal. Hundreds of thousands, millions of dollars were spent on studies showing why it's good, why it's bad. When it finally happened in December, it went down with a whimper because the market had changed. It didn't matter anymore. There's no incentive to export crude from the U.S. in the current environment, and there will be limited incentive in the near term, the midterm even potentially. But longer term, it will matter. We will get back to crude production growth. There will be a market where exports are incentivized. It will prevent these large domestic discounts to materialize that otherwise might have. It also removes the incentive to build these so-called crude to product projects that otherwise would have been built to get around the ban. And one thing to note, the East Coast refiners are disadvantaged. All market distortions have not been removed. So a guy in Rotterdam can get a barrel of crude from the Gulf Coast cheaper than a guy in Philadelphia can. Other regulations are always going to be important in refining business. Very regulated business, obviously. What happens in the next election is going to tell a lot about what happens in those first two items. The RFS standards obviously is being revisited as we hit the blend wall. We can either go beyond that and go towards 15% or more of ethanol in the pool. It's, again, displacing petroleum-based material in gasoline pool, or we can remove that RF, and people have talked about that for the first time. So who knows what's going to happen there? That's a big deal, and other incentives for alternative fuels. Carbon taxes, other petroleum-focused taxes. We've had one thrown out here recently, which probably won't see the light of day in the Republican Congress, but 2016, 2017 could be a different story. Permitting issues, the ability to build facilities, the ability to respond to regulations. That, a lot of times that's regulated on a locality basis, and that's going to be important to refiners. Some more stringent environmental regulations are going to go forward regardless of any election results. Tier 3 gasoline, where we go to 10 parts per million on gasoline, is already in effect. That'll increase costs for refiners to some degree. It'll make octane more expensive as you reduce octane by hydrotreating gasoline. And the low sulfur bunker fuel is going to have impacts on both the resid markets and the diesel markets. Product demand obviously is very key. We don't ever hear about peak oil anymore, but people do talk about peak demand. Now, Howard, showed that, EIA doesn't believe in peak demand, neither do we, neither does IEA. I mean, petroleum's here to stay for a while, but it's harder and harder to predict where it's going to be. It does relate to economic growth. It's harder to predict that economic growth. It's going to return. The demand in developing countries is going to be stronger than demand in developed countries because of demographics, economic maturation levels. But lifestyle changes are going to be very important, particularly in the developed economies. Work from home, reurbanization, things like that work to suppress product demand. It's going to be impacted by technology breakthroughs, potentially in the alternative fuels, even though I don't see that in the horizon. But a breakthrough is a breakthrough because nobody can foresee it, so who knows? Autonomous vehicles keep getting talked about. What impact that will have on demand is hard to say. Could increase it, could decrease it. I actually don't know. That's a difficult one to judge. There could be other factors. Overall, I believe that U.S. refiners will continue to be winners in the world of refining. Their ability to maintain and even grow product exports is going to be key because domestic demand is only seeing a short-term renaissance here in this low-price environment. It's going to essentially be fairly stagnant going forward. Especially critical for the U.S. Gulf Coast guys. It's challenged by the additional refining capacity, not just in places that import our product, but also, as I think David mentioned, the construction of refineries in exporting countries. Some have already come online, more are planned. The benefits of domestic production growth to the U.S. refining industry is there and have been muted now. But a healthy upstream industry, healthy midstream industry will help make a healthier refining industry. I did skip over that point about the regulations, but that's a key one. For us to continue to be leaders, we have to make sure that regulations don't handicap us too much, and that's always a possibility that they could. And this is a huge trade balance issue for the U.S. It's maybe the most important manufacturing industry in the U.S. in terms of trade balance when it comes down to it, if you look at the numbers. The one thing I do expect, if these things go as we expect, there will be more rationalization in the other developed countries, in Japan, other parts of OECD, Asia, and in Europe. They still have an overhang of capacity. And with that, I'm done. And I ran over a little bit, but that's okay.
All right, so we promised you a lot of content. It was delivered with an exceptional amount of insight and a little bit of humor. Let me take 2 questions before we call it a day. So the only rules we have here is identify yourself, wait for a microphone, and ask your question in the form of a question, and then we can wrap up. John Shagas, right down here in front.
John Shagas, Strategic Petroleum Consulting. Howard, there are a couple of major pieces of legislation that require strategic petroleum reserves to sell a lot of oil, but the volumes are undefined. What assumption do you have in your projections for sales in 2017?
I think we have a very, very small, at the beginning of fiscal 18, which is the last 3 months of 2017, I think one of the sales starts to kick in, but the sales are very backloaded. I mean, in the budget legislation, they were largely backloaded, so there's not much of a, I think I forget the numbers, so I don't want to, but I remember it being in the thousands or low 10,000s, very low 10,000s of barrels per day. So it does not make a big effect in 2017. If you actually got out to 2024, 2025, where the larger things appear, they get to be more material.
Okay. Anyone else? Ariel.
Ariel Cohen, the Atlantic Council. Any thoughts on how putative privatization of Saudi Aramco may affect the production and the management? Thank you.
Well, let me take a stab at that. This is part of a sort of makeover image of the Saudi royal family decision-making, which has been always very quiet. As I mentioned earlier, they're taking a higher profile through the two Mohammeds, but particularly Mohammed bin Salman, and he was the one that proposed this. And I think it's to say that we want to be part of the commercial world more than we are today, is the outside message. The inside message is we want to distribute the income around from probably our major asset to the Saudi people. And I'd be very interested to see what kind of restrictions they may put on who gets to own it. It will trade on the Saudi exchange, so getting onto the exchange first, which seems to be a doable thing, is not all of it. And obviously it doesn't go over 49%, so in terms of and I would be surprised if it went over 10 or 15%. The model is some of the downstream refining joint venture arrangement. So it's a sharing. It can bring in some money, which is not a small thing for them. Remember, there was an 800 billion pile of stuff, which is now more like 600 billion in terms of just the current account funding that's required at these lower oil prices. I do not think that as others have made a point, that this is a major part of their decision-making is looking at their financial position. I don't agree with that. I think it's not only it's a big pile, but there's so much more behind that. I mean, all of us would loan money to Saudi Arabia. We don't get interest, but we get a fee, so it's okay, Islamically.
So this discussion today has left fodder for future sessions. Thank you all for coming, and please help me join in welcoming and thanking our panel.